Volatility was originally a measurement of variation in a stock's price, usually denoted as sigma. However, the Chicago Board Options Exchange, or CBOE, has seen to it that volatility be made a traded financial product, complete with its own second and third order derivatives. It is now the most consequential product on the market today. An American call option is the right to purchase shares of a stock at a given price at some point in the future. But since an option is the right rather than the obligation to purchase, it becomes difficult to value. Thus, we make assumptions regarding the potential range of movement of the stock to assess the probability that the option will be in the money. In other words, we make an assumption about the volatility. In a way, if you are trading options, you are trading volatility. Theoretically, with mathematics, the current market prices of options can be used to infer expected market volatility. This is called implied volatility because it is implied from the current market pricing of options. The VIX is an example of a quantified implied volatility of the S&P 500 index. And contrary to popular belief, implied volatility does not represent the risk in the market. Rather, it represents the market price of risk. The quantification of volatility has transformed from being a source of information to being a financial product itself. Since trading options is trading volatility, this financial product is valuable for hedging volatility exposure. However, as is the case with most derivative instruments, a risk mitigation tool is just as easily used for leveraged speculation. Direct long volatility exposure means buying the VIX futures contracts and never having to worry about buying options or shares. However, there are even more products built on top of VIX futures contracts. Exchange-traded products, or ETPs, and exchange-traded notes, or ETNs, also provide long or short volatility exposure through buying VIX contracts, some of which are levered products. Further, one can buy options on these ETPs or even contracts on the volatility of volatility itself, or the VVIX. Movements in each of these products have direct impacts up and down the derivative chain. These derivatives also interact indirectly through the reliably consistent actions of market participants who have exposure at each level. For example, an options dealer will buy or sell equities in order to hedge their options position. This is called delta hedging. Or a risk parity fund will scale its equity exposure based on measures of volatility. Even a retail trader who sold strangles into spiking liquidity may have their broker liquidate other holdings to cover their exposure. Together, these make up the volatility complex. This diagram is a simplification of the volatility complex. In reality, this same structure is repeated over and over again in single-name stocks, larger ETFs, and indices, all interacting with each other in the underlying shares in complex ways. Yet they are all bound by specific forces. Each incremental derivative level creates incremental potential exposure and complexity, while also magnifying the potential short exposure. This ever-growing chain of volatility products with increasing size relative to underlying assets, as well as the challenge of isolating the indirect relationships, means no person has an accurate model of how all of these pieces fit together. In other words, outcomes are extremely uncertain, even with everything being considered. We established that volatility is a traded product in which price is determined by buyers and sellers. One can go long or short volatility in the same way that one can buy or sell a stock. But similar to GameStop, there are asymmetric tails. Short volatility has a very long tail of downside. An American put option acts like insurance from the long position perspective. Buying a put provides the right to sell a stock at a specific price in the future, guaranteeing a floor price for which the stock can be sold if the market were to drop. The most money a put buyer can lose is 100% of the premium. For example, since one option contract represents 100 shares of an underlying stock, if I buy 1,000 puts for the premium of 1 cent, then I pay $1,000. If by the put's expiration date the put is not in the money, then I lose $1,000 and nothing more. The insurer, or the party that sold the put to the buyer, is obligated for however much the stock drops below the strike price, which could be multiple times larger than the premium they received. The potential exposure a trader takes by selling this insurance is multiple times higher than the actual money they receive in the trade. The volatility complex is much more expansive and interconnected than a single index, but for simplicity, consider the most common volatility measure, the VIX. If you are short the VIX and the volatility spikes, you will quickly see significant losses and may be forced to cover. This may be done through simply selling the product or buying volatility as an offset, but the net result is that a former seller of volatility is forced to buy volatility, which, of course, adds to upward pressure on the price of volatility. This is not theoretical. Another example of a short squeeze prior to GameStop occurred on February 5, 2018, now known as Volmageddon. On February 5, 2018, the VIX spiked from $17 to $37 in a single day. Interestingly, there was no external catalyst or market event that seemed to justify the massive increase in volatility. To help explain what happened that day, this post-mortem analysis of Volmageddon published by the CFA Institute is extremely revealing. A sudden rise in market volatility on the 5th of February led to a one-day loss of more than 90% in the value of short volatility exchange-traded products, or ETPs. Both ETPs, XIV and SVXY, were designed to provide investors with a return that mirrors the inverse performance of the S&P VIX Short-Term Futures Index, or shorting volatility. When volatility spiked on February 2018, there was a sharp fall in the value of short volatility ETPs, and an increase in the notional exposure of their short VIX futures positions. To remain market neutral, the ETPs needed to buy a large number of VIX futures contracts. This purchase of VIX futures had a significant positive price impact on futures prices and led to further drops in the AUM, or assets under management, of the ETPs. This necessitated further rebalancing and therefore even more shrinkage of AUM. The large market share in VIX futures contracts held by leveraged ETPs exacerbated the volatility shock, sending the ETP's rebalancing mechanisms into overdrive. This negative feedback loop kept pushing futures prices upward, leading to huge downward pressure on the ETP's AUM and eventually to investor losses of around 90%. Simply put, no pun intended, volatility was squeezed. Specifically, a structured volatility product was squeezed. The mathematical covering process employed by the structured product created a feedback loop that led to capitulation and near total wipeout of those who were short. Similarly to what transpired with GME, the roots of Volmageddon far precede February 5, 2018. Up until early 2018, the VIX had been in a consistent march downward since mid-2016. For years, shorting the VIX was a great trade. In fact, it had become almost like free money. Along with other factors, this is because there is a bias in world markets for equity market prices to rise. From 2016 through early 2018, the product quintupled. Every small volatility spike that temporarily dented performance was quickly overcome as the VIX continued to drift lower. As with all free money trades, it became crowded and undervalued, and the ETPs became an increasingly larger player in the market. Further, while the focus is on the ultimate capitulation on February 5th, the short squeeze began well before that date. The VIX reached a recent low of around $9 on January 4th, a month prior to Volmageddon. From January 4th to February 2nd, the VIX nearly doubled from $9 to $17, putting significant pressure on volatility sellers. A shrewd trader may have noticed the VIX rising in early January and closed their short volatility position or bought volatility in advance. But an even shrewder trader may have had much further insight, noting that the volatility and the volatility of volatility had significantly decoupled from their historical correlation, implying that the market could be underpricing volatility. From April 2017 to February 2018, the VIX continued to decline while the VVIX had steadily increased. Ultimately, the two converged on Volmageddon. So, the Volmageddon follows the same architecture as GameStop. Shorting volatility was profitable for years, attracting attention in a long-term, self-reinforcing cycle. A crowded trade reached a tipping point in which the risk-reward flipped. The short squeeze occurred from January 4th to February 2nd and ended in capitulation on the 5th of February. Contrarians who recognized the squeeze in real time made great returns, while short volatility sellers were completely wiped out. A short squeeze is the meeting of asymmetric tails and forced covering. Most importantly, there was not an obvious catalyst for the market movement. Rather, it was due solely to the forced covering of a derivative product. Now let us evaluate the present. Volatility, as measured by the VIX, has in general declined since March 17, 2020. After the incredible realized volatility from February to March 2020, attributed to a panic over the COVID pandemic, the market price of volatility was incredibly elevated. Meanwhile, the realized volatility has only compressed. Here is the realized S&P volatility going back to 2015. The collapse of realized volatility since March is clear but also mirrors the past three volatility cycles. The compression of realized volatility has compressed the market's pricing of volatility. This seems intuitive, but in actuality, it is the gambler's fallacy. Recent history does not necessarily dictate the future, and a longer historical analysis shows that periods of high realized volatility do occur. These occur abruptly and after a long period of declined realized volatility. This makes sense with the context of the market rising and falling. Looking at the correlation between the VIX and the VVIX, which was an early forewarning of Volmageddon, we notice more ominous signs. After remaining relatively well coupled from over a year from March 2020 to April 2021, the VVIX reached a post-COVID low on April 9th and has risen significantly since then. Meanwhile, the VIX continued to decline throughout the late summer until reaching a low point in early July. This VIX over VVIX divergence over the past several months and quick convergence that we are seeing recently corresponds with the action prior to the two most recent volatility squeezes, the September 2018 sell-off and the March 2020 COVID crash. While this divergence is a longer-term risk indicator, it doesn't mean a reversion is imminent, but more recent action in the VIX provides a more imminent warning. After driving to new lows nearly every month since the March 2020 crash, the VIX reached a distinct local bottom in early July. The VIX has risen over 50% since then. The important factor for the squeeze dynamics is its change off the lows. With each movement higher, there is more pressure on volatility sellers. Like GameStop from $4 to $20, losses can be withstood for a period of time but not indefinitely. At some point, someone goes upside down and is forced to sell. At some point, someone really big goes upside down, and a short squeeze is the meeting of asymmetric tails and forced covering. Yes, the VIX has increased for extended periods of time since the COVID crash, like since September 2020 or leading into January 2021, but there are several key differences. Firstly, the lower the VIX falls and the more crowded the trade becomes, the more likely a squeeze becomes inevitable. Second, looking back to the VIX chart, the VIX looked appropriately priced relative to the VVIX prior to April 2021, which implies that the market was not meaningfully underpricing volatility during these periods. But thirdly, shorting volatility has become more and more crowded, becoming popular within professional and retail traders alike. Finally, the economic outlook by all measures would have been seen as improving during those periods. Today, the opposite is true. Growth has peaked, fiscal and monetary measures have ended, dollar liquidity is fading, inflation is a real concern, corporate margins are under pressure, and there is an energy crisis underway. This rise in volatility has also come with a significant increase in realized volatility, with equities selling off significantly. The greater than 2% decline in the S&P on September 28th was the largest move since May. The squeeze will play out over time before its final capitulation. The capitulation may be triggered by a period of high realized volatility, perhaps due to an unforeseen event, which may put specific volatility sellers out of the money, forcing them to quickly cover. Alternatively, a slower shift in the balance of volatility supply could cause a more gradual repricing of volatility that applies slow but increasing upward pressure on volatility. This could be active through investors seeking hedge protection, for example buying puts, or passive as options positions expire, or some other feedback loops such as spot prices drifting further from open calls and closer to open puts. Given the intertwined volatility derivative universe, we can't predict exactly where in the volatility complex this would arise, but a breakdown at any level of the derivative chain would lead to chaos elsewhere. There are enormous potential exposures here. It is certainly possible that short sellers will remain in control of the market for the coming weeks or months, but until the VIX takes out its July lows, the battle is on. Okay, but maybe you're a conservative trader with unlevered long positions in blue chip stocks. Do you need to care? Yes, you still need to care. If you found this video informative, please like and subscribe to the Quant Bear.